Why you should be investing right now. Despite the fact that investing is one of the most efficient ways to increase your wealth and ensure your financial future, a lot of individuals are reluctant to take the initial step in the process. Whether you are putting money away for a comfortable retirement, the education of your children, or the purchase of a property of your dreams, beginning your savings early provides you with the benefit of time as well as the power of compound interest. There has never been a better time to start investing than now, given that inflation is cutting into the value of cash that is sitting idle, and new platforms are making investing accessible to everyone. Putting money into investments today puts you on the right track to accomplishing your long-term financial objectives and constructing a more secure tomorrow. Number 8. The power of compounding investing. Early allows you to take advantage of the power of compound interest, which guarantees that you will earn returns not just on your initial investment, but also on the profits that increase over the course of time, due to the fact that this exponential growth gets faster as the investment period gets longer. Time is the most important aspect in the process of accumulating money. In the span of 10 years, for instance, a $10,000 initial investment that grows at an average yearly rate of 8% nearly doubles to around $21,600. It grows to approximately $100,600 in 30 years, which is a tenfold increase from its current level of approximately $46,600 after 20 years. Beginning early provides your money with additional time to compound, which leads to a significant acceleration of growth. Number 7. Inflation protection. Maintaining cash in a savings account exposes it to the possibility of experiencing a gradual decrease in purchasing power as a result of inflation. Inflation is the process by which the value of money decreases over the course of time. For the purpose of mitigating the effects of this phenomena, it is advantageous to make investments in assets that are geared toward growth, such as stocks, real estate, or index funds. When it comes to returns, these assets frequently yield returns that are higher than the rate of inflation. It will not only be possible for you to preserve the actual value of your wealth, but you will also be able to create opportunities for it to grow over the course of time. This will make it possible for you to accomplish your long-term financial goals and can guarantee that you will maintain a steady financial situation. Number 6. Market accessibility. Investing has become a great deal simpler to access than it was in the past, thanks to the proliferation of modern online platforms such as Robinhood, E-Trade, and Fidelity. These platforms provide user-friendly interfaces and trading without commissions. These platforms lower the barriers to entry by allowing customers to start investing with minimum quantities, which may often be as little as a few dollars. This makes it possible for individuals to begin constructing a portfolio even on a basic budget as they begin their journey into the world of investments. In addition to this, they provide investors with access to educational resources, automated tools, and features such as fractional shares, which allow them to purchase portions of expensive stocks. Number 5. Diversified opportunities. Securities, bonds, exchange-traded funds, ETFs, real estate, and cryptocurrencies are just some of the investment possibilities that are available to investors. These options are designed to accommodate a wide range of financial objectives and levels of risk tolerance. Through the practice of diversification across several asset classes, investors are able to lessen the impact of a single investment's bad performance, so distributing risk across their portfolios. In addition, diversification allows for exposure to a variety of market opportunities, which can help to mitigate the effects of volatility and increase the possibility of attaining consistent returns over sustained periods of time. Number 4. Achieving financial goals. When it comes to achieving significant long-term objectives, like as purchasing a home, ensuring that your children will have a comfortable retirement, or giving financial support for their schooling, investing is a powerful tool that should be taken into consideration. When you invest your money in assets that are focused on growth, you can create a financial buffer that grows over time. You won't have to turn to debt in order to meet your future financial obligations because this cushion will give you the resources you require. Number 3. Learning and growth. When you begin investing at an early age, you have the chance and the time to grasp the complexities of the financial markets, to comprehend how various assets act, and to establish investment strategies that are successful. When you are just starting out, it is possible that you will make mistakes. Yet, these early mistakes can be extremely beneficial learning experiences that will assist you in better comprehending market cycles, risk management, and the significance of patience. This might help you refine your strategy and avoid making larger mistakes in the future. If you make little mistakes early on, you acquire insight into what works and what doesn't work, which can save you time and money. Over time, you will become more accustomed to the ups and downs of the market, which will result in an increase in your self-assurance and an improvement in your ability to make decisions. Because of this early exposure, you will be able to modify your tactics as you gain the necessary knowledge, which will ultimately position you for more effective long-term investing. Number 2. Economic recovery and growth. Potential markets have shown resilience over time, consistently recovering from economic downturns and financial crises, often providing significant returns for long-term investors who remain committed during periods of uncertainty. While market fluctuations, such as recessions or corrections, can cause short-term losses, history has demonstrated that the markets tend to rebound over the long run. For instance, after the 2008 financial crisis and the COVID-19 pandemic market crash in 2020, the stock market eventually surged to new highs, rewarding those who stayed invested. By maintaining your investments through turbulent times, you avoid the pitfalls of market timing, which can often lead to missed opportunities. When you stay invested, you're positioned to benefit from the eventual recovery and long-term growth that follows these temporary setbacks. This approach allows you to capitalize on the compounding growth that comes with reinvesting dividends and interest over time, maximizing your returns in the years ahead. Number 1. Tailored risk management. Optimizing returns while controlling risk can be accomplished by aligning investments with your risk tolerance and the time scale you have set for your finances. Younger investors that have longer time horizons are able to afford to take on higher risk assets such as stocks, growth funds, or developing markets. These types of investments offer greater potential for returns and allow for more time to recover from swings in the market. On the other hand, individuals who are getting close to retirement frequently place a higher priority on the preservation of their money, which makes assets with a lower level of risk, such as bonds, dividend-paying equities, or treasury securities, more appropriate. With this adjustment in strategy, you can ensure that there is a balance between growth and stability, and that your investments are aligned with your developing financial goals. Thanks for watching and subscribing channel.